Usually, when we look at a corporate earnings report, there is this expectation of like a clean, linear logic.
Right, a simple cause and effect.
Exactly. A company misses its revenue targets and the stock goes down. It's the standard playbook that plays out every single day on Wall Street.
That is the traditional binary we're all taught to expect, yeah. I mean, you hit the number, you're rewarded. You miss the number, investors pull their money out.
But then you step into the world of regional banking in 2026, and suddenly that logic just gets completely upended.
Oh, totally thrown out the window.
Right. So we are looking at a market reaction today that demands much closer inspection, really, because the surface-level numbers just do not match the investor response at all.
It's a textbook example of counterintuitive market behavior. And, it tells you that institutional investors are looking deep into the mechanics of the business, rather than just glancing at the top-line summary.
Welcome to the Deep Dive. Today, we are looking at Simmons First National Corporation. They trade under the ticker symbol SFNC, and they just released their Q1 2026 earnings.
And this is where it gets interesting.
Yeah, so the street expected $243.02 million in revenue, and they came in slightly under that at $241.37 million.
So a top-line miss.
A miss. But in the hours following that report, their stock jumped over 5.5%, hitting $21.59.
Which is wild, right? A massive rally on a revenue miss is rare. It indicates that the quality of the underlying earnings, like how they're actually making their money and setting up for the future, is exceptionally strong.
And to figure out why, we aren't just relying on analyst summaries. We went straight to the primary sources for you. We are pulling apart their Q1 2026 earnings press release, the slide deck they presented to investors, and the actual raw transcript of the earnings call.
That features CEO Jay Brogdon and CFO Daniel Hobbs, right?
Yeah, exactly.
Going through that raw transcript is so crucial because, you get to hear the unscripted Q&A with analysts. You really hear where the executives are confident and, where they are a bit more cautious.
So, for you listening, the mission of this deep dive is to understand the anatomy of a successful regional bank right now. If you want to understand how a bank survives and actually thrives in 2026, Simmons is kind of the perfect blueprint.
They really are.
Because beneath that slight revenue miss, they are managing a massive 10% loan growth rate, they're actively widening their profit margins, and they're navigating some pretty complex commercial real estate risks.
Oh, and doing all of this while protecting a dividend they've paid for 117 consecutive years.
Yeah, 117 years. We are going to decode their playbook today.
And that playbook is incredibly relevant right now, The regional banking sector has been under a microscope for a few years, so seeing a bank engineer this kind of outcome, it offers a lot of lessons about modern financial management.
We have to start with the most glaring number from the report, which is their loan growth. It sets the stage for everything else they achieved this quarter.
It's the engine.
Right. Simmons posted a 10% annualized loan growth in the first quarter. And their unfunded commitments, which are basically loans they've agreed to make but just haven't paid out yet, increased by 5% from the previous quarter.
Those unfunded commitments are a critical leading indicator, by the way. It shows the pipeline isn't drying up, it is actively refilling.
Okay, let's unpack this. Because I'm looking at the broader 2026 economy, and it's relatively stagnant. Borrowing costs are still really high.
Very high, yeah.
So hitting 10% organic loan growth right now is like a sailboat catching a massive gust of wind when everyone else is just totally becalmed on the water.
Yeah.
How on earth are they doing that? Is this just a lucky quarter where a few massive deals happen to close at the same time?
CEO Jay Brogdon actually addressed that dynamic directly on the call. And the short answer is no. It's not just luck. He attributes this growth to a multi-year restructuring program they called the Better Bank Initiative. Over the last few years, they haven't just been waiting for the market to come to them. They've been actively changing the internal behaviors of the bank.
Okay, but what does that actually mean operationally? Because, Better Bank Initiative sounds like standard corporate marketing speak.
Oh, it totally does. Fair point. But in practice, it meant changing their internal incentive plans and breaking down silos.
Breaking down silos how?
Well, historically at many banks, a loan officer writes a commercial loan, gets their commission, and moves on. Simmons restructured their compensation and their targeting so that their teams are incentivized to capture the entire client relationship, not just a single transaction.
Oh, wow.
Yeah, and it takes years to change corporate culture like that. Q1 2026 is really the inflection point where those investments are clearly bearing fruit.
I noticed in the transcript they also made some major strategic talent investments recently. Like they brought in new consumer and commercial leaders just a couple of months ago to drive this exact strategy.
And the commercial side is where this gets fascinating. They are shifting away from being a pure, lender and moving heavily into commercial treasury management.
Treasury management being like the software and services a business uses to handle its daily cash flow, payroll, vendor payments, that kind of thing.
Yes, exactly. Because think about it. If you only provide a loan to a business, you're a commodity.
Right.
They will leave you the second another bank offers a lower interest rate.
Yeah.
But if you integrate into their treasury management, if you are the platform processing their employee payroll and handling their daily receivables, you become indispensable.
The friction of leaving is just too high at that point. I mean, an IT department isn't going to want to rip out their entire payroll and payment system just to save a fraction of a percent on a loan.
Exactly. It makes the client incredibly sticky. It creates a deeply entrenched relationship.
Mhm.
And we are seeing that stickiness translate to their wealth management division as well.
Oh, right. The new wealth team.
Yeah, they hired a new wealth management team in January and March of this year. And in just a few months, that single team brought over $350 million in assets under management, or AUM, either physically transferred or verbally committed.
Wait, really? That is a staggering amount of money to move in a matter of weeks.
It's huge, and it proves the value of acquiring high-reputation bankers. High net worth clients don't usually have loyalty to a corporate logo. They have loyalty to the specific advisor they trust.
Yeah, that makes sense.
And Brogdon noted that this new wealth team is already referring their clients back into the commercial and private banking divisions. It creates this flywheel effect where one wealthy client utilizes 3 or 4 different profitable services across the bank.
But the CEO was very careful not to declare an early victory on the call, right?
Oh, absolutely. He was highly disciplined about managing expectations. He explicitly stated they do not promise 10% annualized growth every single quarter moving forward.
Right, because there are still macro factors at play.
Exactly. He is clear-eyed about the macroeconomic uncertainties out there. He specifically cited fuel prices keeping corporate clients cautious and aggressive pricing competition from bigger banks moving into their regional footprint.
So they know they have momentum, but they aren't pretending the broader economy is without risks.
Precisely.
But, that massive 10% loan growth creates an immediate math problem for Simmons. You cannot lend out money you don't actually hold in the vault. To fund that loan growth, they need deposits.
Yeah.
And they have to pay for those deposits.
This brings us to the core mechanics of bank profitability. CFO Daniel Hobbs specifically called their deposit dynamics the key governor of their loan growth. They will only grow their loans as fast as they can grow their deposit base to fund them safely.
So what does this all mean for their margins? Because the numbers they reported on this front are arguably the main reason the stock rallied today.
It's a huge part of it.
Their net interest margin, which is the spread between the interest they earn on loans and the interest they pay out on deposits, expanded by 3 basis points to 3.84%. And the overall cost of their deposits actually decreased by 8 basis points.
We should probably define what a basis point is, just because it sounds minuscule.
Good call.
A basis point is just 1/100th of 1%.
So 8 basis points is 0.08%.
Yes. And on a personal savings account, that is meaningless. But when you apply that 0.08% cost reduction across a regional bank's multi-billion-dollar deposit base, it translates to millions of dollars falling straight to the bottom line.
It's like they swapped out premium, really expensive gas for a cheaper fuel blend, but the engine's actually running faster.
That's a great way to put it.
But with inflation worries still lingering out there in 2026, aren't customers demanding higher rates on their savings? How is Simmons managing to pay less for deposits in an environment where cash is still king?
What's fascinating here is that the answer lies in the mechanics of CD, or certificate of deposit, repricing. You have to look at the timing.
Okay.
Think about the CDs that customers locked in a year or two ago when interest rates were hitting their peak. Those highly expensive time deposits are now maturing. The transcript shows that the CDs maturing in Q1 were costing the bank about 3.56%.
And when those mature, the bank doesn't have to offer that peak rate anymore.
Exactly the opposite. The new CDs coming onto their books are pricing around 3.13%.
Wow, okay.
So just through the natural passage of time as old contracts expire and new ones are written, they're shaving over 40 basis points off the cost of those specific funds.
But they aren't just sitting around waiting for CDs to expire, right? They are actively trying to change the kind of deposits they rely on.
Right. They are moving away from those expensive rate-chasing time deposits and focusing on core customer relationships.
Which are like your basic checking and savings accounts that pay very little or zero interest.
Exactly. That is the sticky money we discussed earlier with Treasury Management. I mean, a business checking account that processes payroll every week doesn't demand a 4% yield, it demands reliability.
Right.
And Simmons reported that these consumer and commercial core deposits are stabilizing and actually growing 2% to 3% year over year.
This deposit remixing ties directly into their forward guidance, which introduces a really interesting economic paradox.
Yeah, the rate cut guidance.
Right. They guided for net interest income growth of 9% to 11% for 2026. But they originally modeled that, assuming the Federal Reserve was going to cut interest rates twice this year. Now the market expects 0 rate cuts.
Right.
If rates stay high, wouldn't that normally hurt a bank?
You would naturally assume higher rates squeeze banks because they have to pay depositors more. But Simmons went through a structural shift last year. They moved from being a liability-sensitive bank to being slightly asset-sensitive.
Let's make sure that mechanism is clear for everyone. If I have an adjustable rate mortgage on my house, when the Fed keeps rates high, my monthly payment automatically ratchets up. It hurts me, but it benefits the bank holding the loan.
That is the perfect analogy. From the bank's perspective, being asset-sensitive means a large portion of their commercial loans act just like that adjustable rate mortgage.
Okay.
When rates stay high, the interest they charge their borrowers automatically floats upward. Meanwhile, because they have focused on those sticky checking accounts we just talked about, the interest they pay out stays relatively flat.
Got it. So the revenue side floats up and the expense side stays anchored.
Which is why the current no-rate cut environment is actually a massive tailwind for them. CFO Daniel Hobbs stated that because rates are staying higher for longer, they now anticipate hitting the absolute top of that 9% to 11% guidance range.
Oh, wow.
Yeah, they expect that net interest margin to drive toward the mid-380s.
Okay, so the engine is running fast with 10% loan growth, and they are funding it efficiently. But, lending money always carries the risk that it doesn't come back.
Always.
And there is one metric in this earnings report that stands out as a potential warning sign. A flashing red light on the dashboard, so to speak. Roughly $30 million of loans moved to non-accrual status in Q1.
And a non-accrual loan is essentially a loan where the bank has stopped counting the expected interest as revenue because the borrower has fallen behind on payments.
Right. And seeing $30 million in non-accruals in a headline sounds terrifying for an investor. We hear constantly about the fragility of commercial real estate. If I'm listening to this and I have money in regional banks, should this isolated incident make me worried about a broader commercial real estate collapse?
Well, analysts pressed them hard on this during the Q&A, and the context provided is crucial here. If we connect this to the bigger picture, this is not a symptom of systemic rot across their loan book.
Okay, that's reassuring.
According to the CEO, that non-accrual bump is almost entirely isolated to a single borrower relationship.
Wait, a single client caused a $30 million jump?
A single relationship spread across multiple properties, yeah.
Mm-hmm.
About $18 million of that increase is tied specifically to the construction of 1 to 4 family properties.
Gotcha.
Furthermore, this isn't a loan Simmons originated recently under their current underwriting standards. It is a legacy relationship they inherited during a past merger.
Okay, but an inherited problem is still a $30 million problem on the balance sheet. Do they expect to take a massive loss on these properties?
Here's where we have to distinguish between a fundamental default and a technical delay.
Okay.
A fundamental default is the nightmare scenario. A borrower goes completely broke, a construction project is abandoned half-finished, the real estate market crashes, and the underlying asset is practically worthless. In that scenario, yeah, the bank takes a massive loss.
But that isn't what is happening here.
No. What Simmons is dealing with is a technical legal delay. Management expressed extreme confidence that there is minimal expected loss on these properties because of very low loan-to-value ratios, or LTVs.
Meaning the borrower had to put a massive amount of their own cash or equity into the project from day one.
Yes, Because, if a project has a 60% loan-to-value ratio, it means the market value of that property would have to plummet by 40% before the bank's principal is even touched.
And they have that buffer.
They do. Simmons has fresh appraisals on these properties confirming that equity buffer is totally intact. The CEO explicitly stated that the migration to non-accrual was largely forced by delays in legal proceedings, literally just the court system backing things up.
Ah, okay. So the physical houses securing the loan still have massive value, but because the loan is trapped in legal red tape, strict accounting rules force them to classify it as non-accrual.
Exactly. It is a paperwork and timeline headache, not a balance sheet disaster. And you can see management's confidence reflected in their broader risk metrics.
Like the charge-offs.
Right. Their full-year charge-off guidance, which is the amount of bad debt they actually expect to write off as an unrecoverable loss, remains incredibly steady at just 25 basis points.
And their allowance for credit losses ratio held perfectly steady at 1.28%. So they aren't panicking and hoarding extra cash for a wave of defaults because their proactive inspection of the portfolio shows there isn't a wave coming.
Exactly. It demonstrates that proactive, disciplined credit management prevents isolated legal hiccups from becoming broad-based deterioration.
And that discipline directly translates to the bottom line, which is how we translate revenue into actual profit. Their earnings per share met expectations at 47 cents.
Which is huge compared to last year.
Yeah, a year ago it was only 26 cents.
Yeah.
That is a massive leap in profitability. Their pre-provision net revenue, the money they make from core operations before setting aside cash for potential bad loans, is up 53% year over year.
But the metric that truly shows the health of their operation is the adjusted efficiency ratio. It dropped an astounding 859 basis points year over year, down to 56.16%.
Let me break that down. An efficiency ratio measures how much it costs a bank to generate $1 of revenue. So dropping to 56.16% means they spend about 56 cents to make $1.
Right.
But how did they achieve an 859 basis point drop in a single year? That usually requires monumental cost cutting.
It is the power of operational leverage. They didn't achieve this just by slashing jobs. They achieved it by growing their revenue significantly while keeping their back office expenses flat.
Oh, I see.
Over the past few years, they invested heavily in technology and internal systems. Now, they're able to process that 10% loan growth and manage that complex treasury software without needing to hire a proportional army of new back office staff.
So they're doing substantially more volume with the exact same operational footprint.
Yes, which means every near dollar of revenue falls much faster to the bottom line.
Here's where it gets really interesting, though. There is a major contradiction in how they are handling all this newfound profitability.
What do you mean?
Well, on the earnings call, management made it very clear they think their stock is fundamentally undervalued. They pointed out it's trading at a very low price-to-earnings multiple based on their forward estimates. Yet, they explicitly stated they are pausing their share repurchase program.
Right, the buybacks.
Yeah. If they're swimming in profits and genuinely think their stock is sitting at a bargain price, why wouldn't they buy it back? Isn't holding off on buybacks leaving money on the table?
It is a brilliant question, and it speaks to their core philosophy of what they term optimal capital. The CFO noted their target is a 10.5% CET1 ratio,
Which is a regulatory metric measuring a bank's core financial strength. Essentially, the shock absorber of equity they hold against their risky assets.
Exactly. Right now, they believe the absolute highest return on investment they can make isn't buying their own stock.
It's the organic growth.
Yes, it's funding that 10% organic loan growth. If you can lend money out to incredibly safe, profitable commercial clients and cement a 10-year treasury management relationship, that yields a far higher, more sustainable return over the next decade than a short-term stock buyback.
Plus, holding that capital gives them a fortress balance sheet. If inflation spikes again or fuel prices trigger a recession, they have the armor to survive it.
It protects their legacy, too. When they discuss capital priorities, number one is funding organic growth. But number two, firmly ahead of stock buybacks, is their dividend.
Oh, right, the streak. They have paid a dividend for 117 consecutive years.
It's unbelievable.
Just think about the historical context of that. That means they were paying a steady dividend to shareholders during the 1918 flu pandemic, through the entirety of the Great Depression, World War II, the 2008 financial crisis, and the 2020 COVID crash.
A streak like that becomes a sacred trust to the investor base. They will not jeopardize a century-old reputation just to financially engineer a short-term bump in their stock price via buybacks.
And they also noted that holding on to this capital positions them well for future regulatory changes, didn't they?
They did, yeah. They mentioned new capital proposals expected from regulators around 2027. These new rules are anticipated to incorporate loan-to-value components into how capital requirements are calculated.
Okay.
And because Simmons lends so conservatively, with those heavy equity buffers we discussed earlier, these new rules are actually expected to benefit their capital position organically.
So they are keeping their powder dry. They are funding highly profitable organic growth, protecting the dividend, and just waiting for the regulatory environment to naturally boost their capital metrics.
It is the epitome of disciplined, long-term capital management.
If you are looking for a masterclass in how a regional bank thrives in early 2026, Simmons First National just provided the syllabus.
They really did.
They aren't just reacting to the macroeconomic environment. They're actively engineering their outcomes. They are driving massive organic growth by redesigning internal incentives and acquiring strategic talent. They are widening their profit margins by smartly remixing their deposit base away from expensive CDs.
And they're staying ruthlessly disciplined on credit risk and capital allocation. They prove to the market that a slight top-line revenue miss doesn't mean the business is failing, as long as the underlying engine of the bank is running at peak operational efficiency.
Before we wrap up, there is one final thought worth exploring based on a brief comment CEO Jay Brogdon made on the call. He mentioned that the massive trillion-dollar megabanks are starting to aggressively muscle into regional commercial real estate markets, hunting for yield.
Which is a huge shift.
It is. So as interest rates stay higher for longer, it leaves you with a fascinating question to ponder. Will the deep, localized community relationships and that sticky treasury management that regional banks have built over a century be enough to fend off the sheer pricing power of the Wall Street titans?
It is going to be the ultimate David versus Goliath scenario for the financial sector over the next few years.
The wind is definitely at Simmons' back right now, but we will have to see if their strategy can continue to outmaneuver the largest players in the industry. Thanks for joining us on this deep dive.